I am Ijoma Omeni, and with me here is an in-house analyst, Patrick Atwaya. So Patrick, what are we watching in 2015?
Well, basically we are watching oil. Oil is still the major story of this year, same as last year. Basically three things came out today, which is Monday, January 12th, to give the bears ammunition to push oil prices further down. Goldman Sachs came out and lowered the outlook for oil for the next 6 months to $42 from around $68. Societe Generale, as another investment bank, came out with a $51 oil price target for the whole of 2015. And then the Saudi Arabian investor, Prince bin Tawal, came out and said oil prices will not hit $100 for some time. So this has again pushed prices lower. The prices were trading at around for Brent around the $48 mark as at currently. So what does this mean? Well, basically it means that for Nigeria again, which is caught in the middle of this ongoing war between the Saudi shale producers, the U.S. shale producers and the Saudi-led OPEC members, the four major OPEC members of Saudi Arabia, Qatar, UAE, and Kuwait, who are trying to push down oil prices. Last week, Saudi Arabia came out and said even if oil prices goes as low as $20, that they are not going to cut output. So it means major worries for both the fiscal and the monetary authorities, because it's yet to be seen how effective the policies they put in place has been so far. As a matter of fact, there's some that argue that the fiscal authorities are behind the curve, so they have a $65 benchmark for crude oil for this year. So some are arguing they need to lower that. And on the monetary side, some are arguing that so far the CBN has not been very effective in using its policy tools to defend the currency as well as keep out the speculators from the market. So these are very dicey times, and again for the stock market, it just means the market cannot rally in such a situation.
Okay. Tell us the various sectors this will impact.
Okay, so I've mentioned some of them. You have the stocks, you have the subnationals, you have manufacturers, and you also have the federal government, the sovereign. So I'll start with the stocks. I mean, the stock market right now is showing very bearish signals. Last week we did about 6 days straight of sell in the market. Any little rally that occurs, investors use that to sell off more shares. So in the current environment, it's all negative, and there's a very strong correlation between the oil price and the way the markets are trading. And so until that turns, or until we hit a bottom in the oil prices, we will not see a turnaround in the stock market. So anybody that's trying to play the markets right now will see that in a couple of weeks they can get in at much cheaper prices. So there'll be no reason to buy now. Instead, if investors may want to sell down more at current prices. Then you have the states. We did an analysis of some of the current state budgets that they proposed, and we see that a lot of the states right now are living in denial. They're not really priced in this falling oil prices into their budgets that they're proposing for this year. Now, apart from Lagos State, the rest of the 35 states get, on average, between 80 and 90% of their revenues from crude oil sales. Now, if oil prices are down 50% last year, we're down 50% last year, that's going from $100 to $50. around $48 right now. And they're forecast to fall further this year. I don't see how it's possible that these states that get almost 90% of their revenues from oil sales will maintain the same level of spending this year. So, and then the other aspect is, okay, if they cannot get their spending levels, if they cannot maintain this level of spending from getting revenue from oil, where will they get the money from? Well, the only other two areas are bank loans and of course and bonds. But those two areas are also pressured. Banks are retreating because of liquidity issues, tight monetary policies. On the other side, the investors would rather loan to the sovereign than the states because they know some of these states are not very much credit worthy. So it is a dicey situation. The states need to cut back on leakages, cut back on some of their overbloated staff, and just prepare for these late times. And it seems to me that, or it seems to us at the Wednesday that a lot of these states are not prepared for what is coming to hit them. The other thing I talked about was the sovereign. Well, the sovereign has a little bit more leeway to borrow to mitigate the downturn in oil prices, but there's a price to that, which is higher yields that you have to pay, or higher interest rates you have to pay. Some analysts are seeing not of 18% on average for this year, so that's very expensive. But at least the sovereign and the sovereign balance sheet is okay. I think it's about less than 20% of GDP is the loan, the outstanding debt of the sovereign. So there's room to grow. You can ramp it up to 50% of GDP. But the issue there is at what rates, So last year, the DMO issued bonds on average of between 12 and 13%. This year, we're going to see a spike to between 16 and 18%, which is very expensive for the sovereign. And then finally, manufacturers are also going to have issues with sourcing dollars for their import of raw materials if the oil prices continue to fall. And if they have to go to the black market, then the cost of those sourcing those dollars will spike, and it will also hit the final cost of the finished goods, which will feed into inflation. So those are some of the sectors that will have a problem with this.
Okay. What are the lessons for Nigeria, and how do we solve this? Well,
it's sometimes when oil prices fall like this, it's actually a good and a bad thing. So short term, you see short term pain, but longer term, if the pain forces the country to enact the necessary reforms, then it's a good thing, So you can say there's a short term and a long term solution. The lesson is for everybody, both the federal, the states, and the National Assembly. There has to be a reorientation of the economy. There has to be a reorientation towards savings and investment of excess earnings. The state governors that were arguing that you had to share all the money, I hope they are seeing the lesson in it now, that setting up a sovereign wealth fund, investing in infrastructure to diversify the economy through the sovereign wealth fund, saving the excess crude account and not sharing everything. That is the only way you can mitigate at this crisis, at this point in time. Now, the Saudis and the Kuwaitis, they've amassed a big war chest. That's why they can afford to say if oil goes to $20 per barrel, that they don't care. But the weak hands like Nigeria and Venezuela, who wasted, or frittered away their excess dollar savings during the boom time between 2011 and now, it is for them to learn from these hard times, and it might be 1 or 2 years, 1.5 years of tough times, but we'll come out of it. But is to make sure we learn enact the reforms, learn the lessons, eliminate subsidies, eliminate all the wastages in the system and the leakages, and then we'll be better prepared for the rebound.
Thanks for watching. Until we come your way next time on Business District Logic. Goodbye from us.